Everyone, welcome to today's session. Let's get underway here. Market conditions still dealing with a little bit of a retracement right here, a little bit of a pullback based on some weak job numbers. At least that's part of the catalyst, and we'll talk about that. We'll talk about why that matters a little bit here today as well. And it all leads back to this same chart that we've been talking about here, and that is interest rates. So we'll talk about why, and we'll get into that a little bit here as well. But as far as the big picture, direction alerts still sitting at the upper end of this trend. We've shifted now to mildly bearish, still in the bull market. Remember that the two parts of this market condition is the long-term trend, which is the bull market, which is this upper chart right here. This is that 20-year time frame going all the way back to 2010, and we are, obviously in this perpetual uptrend. The theory behind stocks ultimately is that they're designed to always go higher. So the stock market has and probably will always go higher as long as there is economic growth and expansion. That's what it does. But it has these ebbs and flows, and it has these corrections, and it has these pandemics, and it has all kinds of different things along the way that stop the economic growth and start the economic growth, and we get new technologies along the way where we get the dot-com boom back in the early 2000s, and then we get crypto, and then we get AI, and it's no different. It's always been this way, and it'll always continue to be this way in terms of innovation and product and efficiency and what's driving growth. What do people want to consume? What are ways that different industries and things that are happening? That's just it's the nature of humanity. It's the nature of what we want in terms of our overall progression. Call it evolution if you want. This is what evolution looks like and feels like, and that is we continually want more. We continually want to improve. We continually want better and easier and faster. And that's the fun part of the stock market, is all of these companies that are innovating and doing all of these really cool things to make our lives better and improve quality of life and the human condition essentially, is that trend's continually moving higher. Obviously, there's lots and lots of variations and different companies, and some that are profitable, some that aren't. So things change. Things go from from radio to TV to buggy whips to cars, and the innovation is always moving along, and it's fascinating thing. So one of the things that's interesting is, and this is more of a side note, more of a kind of a theoretical type perspective, and that is we oftentimes, I don't know about how often a lot of you were brought up, but we sometimes have this doomsday mentality in the back of our mind, and that's, we're going to have an Armageddon at some point, or the end of the world's going to be coming near, or we're going to get hit by an asteroid, or aliens are going to take over, or the second coming is going to be here, and the world's going to be saved. Whatever it is that we end up having those mindsets and belief systems in our minds, sometimes that hampers the idea of this expansion, of this human ideal to continually improve and grow and advance. So we get stuck with this idea of, market top, market top, market top, market top. It's never going to continue to move higher, yet it always does, at least for the last 5,000 years, and particularly in the last couple of 100 years where we've been tracking markets and things like that. So, and I'm biased towards that as well. I certainly believe that is the expectation, that is the overall bias. That being said, these always overshoot. We've talked about that a lot. We go too far one direction, we come back. We come too far one direction, we come back. So these ebbs and flows, as far as investment and trading and opportunities in the market, are that they're very fluid and they're always changing. So I wish it was a whole lot easier sometimes, but for the most part, that if we stick to that bias and look for opportunities for growth and ways to be able to grow and protect our wealth, utilizing stocks and be able to manage our risk appropriately, that's really what we're here to do, is to provide that perspective and help provide a tool and a methodology to be able to look for those opportunities. Let's jump in here. Let's look at a little bit shorter term trends here. So my point was that this bull market is still intact, but we're at the upper end of that bull market. We know that. We know some of the conditions that have created this bull market. We know that the the inflation was an issue where we started to get too much money here. We get a pullback. Now we're dealing with inflation, and the Fed has been continually raising interest rates to try and slow inflation. And the issue with the higher interest rates is that it slows economic growth. So the issue right now is talking about economic growth versus inflation. And so the jobs number this morning, it was that the number of jobs that were created were just a little bit lower, and so there's always all kinds of talking points around that, but in essence it's another factor of why should the Fed lower or cut interest rates. Is the economy slowing? And so it actually is a good thing for interest rates. And let's jump over actually just quickly and look at that, because we're seeing TLT in the last 2 days have another nice rally. Okay, and that's what we want to have happen. We want TLT and bonds to move higher. That means interest rates are moving lower. This is the bond market. This is not what the Federal Reserve does. The Federal Reserve is dealing with different interest rates, but the bond market is going to be able to, it's the marketplace for that anticipation. So the Fed, whether the Fed follows the bond market or the bond market follows the Fed, they're kind of locked. They're locked at the hip, joined at the hip, I guess, in terms of what they're going to be doing. And so right now the bond market is rallying based on the fact that low or slow job growth is an indication that the economy is also slowing to some extent, which is another indication that the Fed has now got to start cutting interest rates. Otherwise, they're going to kill the economy and create recession, or an even worse recession. And that's the balance. And that's what the stock market is really skittish about right now. Is, are we going to see slowdown? And remember, what the stock market is always looking forward. The stock market is looking into the future and saying, what's the future going to be like for companies? Is it going to be a positive situation, an easy scenario for companies to grow, therefore be more profitable, therefore stock prices increase? Or is it going to be a lot tighter economy and harder for companies to grow, therefore less profitability and lower stock prices? So that's the real, that's kind of the really broad perspective of what's happening and what the market is doing. And part of the volatility, these big sharp moves that we're getting, is we're at the upper end of this trend. And the issue is the Fed's stuck in a couple of places that if they continue to keep rates high, we know that, and if inflation doesn't get under control, which it has been for the most part, then they are going to have to keep rates high, which is going to continue to slow the economy, which is ultimately going to create recession, which is going to kill stock prices. Okay, so I think it's still just a matter of time before we even get more of these economic numbers. It's usually the case, in my experience in the last 25 years, is the market doesn't ever want to believe that the Fed has turned things over into a recession, and it almost always does. It's, things could be different. They rarely are different, but in this case, markets always want to have a little bit of FOMO, a little bit of optimism, and then when that optimism leaves, it leaves really quickly, and that's when we get some of these downturns. So I would expect some continued volatility, potentially even in this upper range. If on this 2-year chart of SPY, you can see now really where we've been, and maybe something feeling like this was last year at this time. We talked about this on Tuesday, where we were sitting right around here on early September, and this was how September and October looked. And so we're kind of starting that type of feel right here as well, where we had a little bit bigger retracement maybe here, and then we had some rally. This was a lot stronger rally, but it's, that's still conjecture. That's still looking, what do I think is going to happen? I don't know what's going to happen. All I know is that stocks go up and stocks go down, and economies grow and economies contract, and that's the game we're in, is trying to be able to jump in front of that bus and ride along with that, or get out of the way of the bus and hold on to some capital before things come unglued, and try and see some of those clues that are happening. So the real biggest, the big clues that are out there right now, I'll come back to buy-sell ratio, are still the short end of this yield curve has to come down. And so, and it hasn't yet. So all of these items that are being talked about are in anticipation of, is the Fed and can the Fed lower interest rates, and can they do it quickly? They certainly can, but if they do it quickly, it's going to be because things in the economy have slowed a lot faster than they anticipated. And when but that also could be, so lower interest rates are good, but the stock market is not going to like a recession. So even though rates come down, that's what's happened back here in a lot of these situations also, is we end up with a high stock market and high interest rates, and then the stock market comes down, we get a recession, and then ultimately that creates a new area of sustainable growth right there and right there. Those are the two big ones going back to 2000, 2007, and then coming up here really for all of 2000, from really 2008 all the way up to, we had a really, with COVID, we just had this really strange scenario where, we had negative rates. The Fed was just giving away money. That was fun while it lasted, but this was the price we all have to pay, and we're still paying some of that price for the ease of liquidity that was given out at that point in time. So that's kind of the undertone in the shorter term as far as just flat out price activity and market breadth. We're getting weakness. We've got a buy sell ratio now that's less than 1. We're getting bears that are getting a little bit more acceleration right here, both on the buy sell, or the buy sell ratio, as well as just price activity. S&P 500. This chart doesn't look that that disturbing, and it's not, because we really haven't had that much of a retracement. But you can see with some of these edges where we're looking at, we do the same thing with a stock trade, right? We say we want to see a stock that's in momentum, and this is really our line in the sand for most stock trades. If we're in the trade, we'll typically have a stop loss right underneath that 236 location to say, if it slices through that, then we're out of momentum, and we run the risk of getting either a corrective move, which was like this, and then right back up, or we just continue to slide and things ultimately head back down again. So this is an interesting chart right now, the 6-month time frame on S&P 500, because of where we're at. We're seeing some bouncing, at least as of right now, that 548 range. And again, this is where on a stock trade we would do the same thing. It's like, okay, we're getting close to a possible stop out or an exit of a position, saying, I just don't want to see if it's going to come this direction, or if it's going to rally and come this direction. That's great, but we've got to still draw the line in the sand at some point. And that can be the same with the market as a whole, or individual stocks as well. So S&P 500 right here, I wouldn't be surprised to see a bounce right here. That those job numbers were not bad. They weren't concerning, but they were in the direction that the market wants to see, and that is a little bit slower economy, so that the Fed will cut rates. And they'll say, okay, we've done our job. Inflation is now slow, but we don't want to kill the economy. We'll kind of get that soft landing. They call that a soft landing, where they can slow the economy but not kill it and turn things into recession. They typically don't do a very good job of that, but that's what the market is trying to anticipate right here, right at these levels. We did see technology, the Qs, and NVIDIA really driving that, kind of getting beat up back here. The Qs never did make it back to the momentum zone, and it just got some resistance. That is also a little bit concerning in terms of, technology stocks typically get hurt the worst in economic recessions and slowdowns, because when companies are no longer buying and they're saying, I don't want to spend any money, we don't have any money to spend, or our budgets are tight, they typically stop buying all the cool stuff, right? When our household budgets get a little tight, what do we not buy? We don't, maybe we don't go buy that new TV, or we don't go buy that new cool thing that we want. We typically don't go buy the new cool fancy things. The companies are the same way. It's like, okay, our technology is fine for another quarter, another 6 months, or whatever the case may be. So tech stocks typically get hit pretty hard, because it's sometimes it's more of a luxury item in some cases for companies to be expanding, and you get more volatility. You typically have higher, richer multiples, and so those stocks just become a lot more volatile because of the speculative nature. traders and investors know that tech stocks have a higher reward to risk, and therefore the sell-offs can happen just as quickly and even more so than maybe a S&P type, as S&P 500 type of name or a Dow type name. That's the cues. Dow actually has been doing pretty well. Had a breakout retracement. You can see a little bit of a bottoming tail bar right here intraday. And we'll see if that holds. If we can hold up right here at these levels and maybe get another little spurt higher. One thing that I've mentioned before on the direction alerts on this timing chart, we typically see a market top spike led by momentum above sentiment. So this is actually setting up pretty nice for a momentum spike to break back up above sentiment. If we start to see that and we start to reach some new highs, then those will be some areas that we want to just really be paying attention to. I'd love to see that, honestly. Love to see another really aggressive rally to the upside, and that may or may not happen, but we're setting up pretty decent for that to happen. This is a real small cup and a handle pattern. Let me go back to S&P 500 right here and go out to that 1 year. A cup and a handle pattern is when you have, this is a little bit deep for that, but you get a retracement lower and then you get another. It runs up and it hits this upper level. So you get the deeper retracement and then you get a smaller retracement that works its way back up to a breakout point. It looks like a teacup. Okay, this handle, that's the cup and that's the handle. Made famous by William O'Neill of Investors Business Daily, that cup and a handle pattern. It's called a lot of different things, but sometimes that's an easier visualization to see that unfolding. And it's typically bullish. It's typically bullish where that handle starts to develop and then it breaks out to the upside. So we'll watch to see if we can get some support right here at these levels, then that overall formation might also be unfolding on S&P 500 at these levels. Let's jump over and look at sectors. We did see some weakness in sectors in the last few days, where we've seen, even just yesterday or the day before, everything was in short-term uptrends. We had a few of those reversing. We're back into some hold signals. Energy is really getting clobbered right here based on USO. This is the sector as a whole as it's continuing to move lower based on, what am I looking for? I'm looking for USO. Let me pull this in here. It's happened on Tuesday as well. We're still dealing with a couple of little data things. USO 1 year time frame. So here's that 1 year time frame. Here's the 6 month time frame. Still nasty, but the momentum's all the way to the downside. You can see how quickly that's been falling. This is oil itself. Whether that doesn't always link directly to the price of those energy stocks, but a lot of times there is some correlation. So we really saw some weakness in energy as a whole in that sector chart here. So again, another little crack in the trend. We're getting sectors that are starting to show some weakness. S&P 500 right at support levels, and the fear is of recession. Bonds are rallying, knowing that interest rates are probably going to get lowered. But are we in or entering recession? Stocks are not going to like that if we start seeing more data that is showing slowdown and significant and prolonged slowdown. Okay, that's kind of the 30,000 foot we are here, you are here perspective. At least as far as the major talking points, I think it is valid to look at the major talking points, because the Federal Reserve and interest rates, the market just flat out follows that. Okay, and so we have to be aware of that. As I've said before, it's why this is here, because the bond market and the money supply is really a huge factor in stock prices. Let's jump over and say, so in terms of our model portfolio, the wheel portfolio we've been trading, we got stopped out of quite a few trades, exited quite a few trades as well, and are back down to that less than 25% holding allocation. And some of these winners, and we had one real big winner over, and that was Space Mobile, which is back up again. Lots of volatility right here. It was up 20%, yesterday, down 15% right here. That was a big winner for us, and we really haven't had anything like that for a month or so. And that could also be, kind of indicative of what the market is doing. Just not a lot of real big breakout type trades right here. And the ones that are working are interest rate sensitive type names like Rocket Mortgage. This is a mortgage company, and so as interest rates come down, you would expect more refinances. You'd expect more home purchases, and therefore more, just more volume for mortgage type companies. That's been a nice trending uptrend, but nothing too insane right here to where we're getting for a month now. We've had 10, 15, barely 20%. Some of these barely tagged that. That again, that may be indicative of what the market is telling us, that it's just weakening. There's just not a lot of aggressive buying. That also unfolds in a lot of the volatility that we've seen. That first round of selling could have been just that. That could have been some aggressive selling by big institutions here, some rallying back up. Now an opportunity for those institutions to start unloading again. And remember that those guys do it over time. They're selling and buying over months versus a day or an hour or something like that. It's really hard to move millions of shares without moving a stock price. And if a company has 1 million shares in their portfolio and they're going to sell them, they typically don't want to unload them all at once, because that does move the market. So they're actually getting lower prices because of the aggressive selling. So they spread out the selling, they spread out the buying, and now that we're back up to some of these upper levels, we'll see if we do get any type of aggressive selling to the downside. Let's jump over and look at some muscle stocks. As I mentioned, we did see Space Mobile, which has been an interesting. I think it jumped yesterday based on the fact that they do have a launch date for that first satellite, and they haven't even got anything out there as of now. It's just, this entire move has just been speculation in anticipation for this growth, and that's what stocks do. That's why they call them. So that's why they call it speculating, is because you're speculating. We think that this company could do amazingly well, but we have no idea. But we're going to buy into that. And when you get these herds that have that mentality, and then once that starts moving, then we want to jump on board, because we're saying, oh, hey, what's going on here? Hey, let's jump on that train. Let's jump on that party, jump in the river and trade it while it's going this direction. Whether or not, and then a lot of times they go up and then they come right back down. But we are in or out, in it in the uptrend, and then stopping out along the way back down again. So it's okay to be able to jump in and trade some of these type of real aggressive names, even if they're not making money or if they are anticipated to make money. That is a lot more speculative in terms of, and volatile. You're going to get a lot more upside quickly, a lot more downside quickly. Same with a lot of these therapeutic biotech drug names that have been popping in here. Same story with those. They're moving really, really aggressively, and they can go up 20 or 30%, down 20 or 30% in a short amount of time. We want to try and catch that the best we can. Let's go through some of these and see if there's anything interesting. Let's see, what am I looking for? I'm looking for this right here. PRAX, that's a decent looking pattern right there, other than this downtrend. Even that's still okay, because that 1 year time frame is quite bullish. That's an interesting price pattern right here. And again, when I say interesting, it's just the fact that I'm looking up here. Okay, this is what I want to see. Is I want to see on whatever time frame we're looking at. For the most of the time we're looking at that 6 month time frame. This 1 year time frame is bullish, because now you're seeing the bulk of the trend, the retracement, the pullback, the continuation. And it's that continuation that I'm saying, oh, that looks interesting, because I would want that to be in the momentum zone above the 236, increasing volume the last couple of days. That's our playground right there. That's where we want to start being interested in these trades. Is it going to move from here? Let's take a look at this. Even say, all right, if we were to take a trade, we did this on Tuesday. Let's do it again, and say, let's say we don't know what happened today. And if we would have or could have taken a trade, what kind of risk profile does that set up for this? So step number one, we already know market conditions. We know that we're finding potential support on S&P 500. We also know that we're at the upper end of the trend. We also know that we could get some reversal. There's some downside risk in the market right here because of the bigger picture where we're sitting in that trend, and that could pause, stall, stop if the economy starts to slow down as well. So what does that mean? That means, well, maybe we don't take a trade today, or maybe we don't take a very big position. If I'm normally doing 2.5%, maybe I do 2%, or maybe I go a little bit lighter even still. But let's look at the number of shares. Let's go with a 2% allocation. 100 shares, 50, let's go to 40, let's go to 30. Looking at this number as I'm changing that. So 35, there we go at 2%. So 35 shares at 2%, and our stop loss, typically, even though this is a kind of a reverse fib level, the 618 instead of the 236, we can still use this entire price activity. And typically you get these holds and then maybe some red in there, but the entire price chunk activity, ideally, if we can set a stop below that level, that gives us a really sound stop, because all of this, think of this as just a massive floor, a massive brick wall of support. And when it comes down, it should retest somewhere inside of this top end or even deeper, and then get a bounce back to the upside. So if we can set our risk level below that, that's a little bit more ideal. So let's call it 48.83. That's that 48 number right here. Let's go 48.75. So 48.75 puts us at 0.39. That's too high. Okay, so we want to go 0.30 or less. A lot of times recently, we've been going down to that 0.20. So remember, we can change two things. If I said I want to keep that stop right there, I have to keep it at 48.75 because my hernia medication, my heartburn medication won't let me do anything less than that, and I don't want to. I just have to keep that stop there. Well, the only thing I control at that point is the number of shares. So I've got to reduce my number of shares. I went down from 35 to 25. That takes me to 0.28. So I'm reducing my risk by lowering my position size. Okay. If I remove that stop, now you can see 1.44. So instead of a 2% allocation, we're sitting at 1.44. Smaller trade, smaller position, but I've got a wider stop. So if I wanted to keep the number of shares at 35 and bump that stop price up and say, yeah, that's a pretty solid move. So is this one the day before. Let's go to $54 and set our stop at 54. Then if it pulls back and hits that level, then we're out of that trade at $54. Okay, so let's put 54 in as the stop, and now we're at 0.21. Okay, so that stop is at 10%. That's about where I've been liking these recently, just based on the market conditions, and that's worked out fairly well. We've had stops happen, but they've been relatively small stops in trying to get some of these stocks that are going to work to allow them some space to be able to work. This would be the risk profile I would set up based on these market conditions at 2%. I may even go a little bit less than 2%, but at 2%, you've got 10%, 0.2%. Those are good round numbers. Then you can take a trade on that. And then again, remember, from there, we've done our job. We can't do anything else. There's nothing we can do but hoot and holler and root for this thing to run higher. Okay, but in terms of the stress and pressure and the anxiety and the worry and everything that we deal with when we deal with money and stock trades is $54. Okay, $54 is my number, and that number was about $200 at risk. So if I'm worried about that number, that's too big of a position. Okay, and I've got to reduce either the share size or the stop loss, and that's your barometer. Your barometer is, how do you feel about that money? Are you constantly checking your brokerage account? If it's this constant thing and I can't stop thinking about this position, your position size is too big. If it's not an issue and you don't think about it ever, you're right where you need to be, because you're following your plan. You've set up your stop so that your risk is mitigated. You've set up the trade based on the setup, and the market conditions are favorable. Your position size is okay based on those market conditions. Your portfolio is being well maintained and trimmed and managed and pruned and hedged. Okay, we've got to think of our portfolio often as our gardens. There's going to be some weeds that creep in there. We've got to get rid of them quickly. That's our losers. We want to try and let these winners run the best that we can as long as they can. But in market conditions, even the winners are only going to stretch maybe a little bit this direction. They're not. And so maybe we do need to take some gains at 10 or 15% instead of letting that run to 20 or 25%. Those are all trading plan adjustments that we can make based on market conditions, or just based on our level of sophistication as far as managing a portfolio, or just flat out saying, I just don't trust the market right now, but I still want to, I still think I can outperform and have some opportunity to make some better gains than I would if I'm just sitting in cash, or just sitting cash. We've got a huge chunk in cash, and that's fine because cash is earning more than it has in a long time, and there's no volatility there as well. Same story with some repetition. That's the name of the game, is repetition, learning the methodology, and then creating the plan so that you can continue to trust the implementation as far as what am I buying, when am I buying it, where's my stop loss, what's my risk, what's my expectation, where am I going to be taking some of the gains based on market conditions. And those are all variable. Those can all change based on your trading plan. They can't change daily, but they can change based on market conditions, and those typically change every 6 months, or even every 3 or 4 months. There might be some tweaks that you can make, and the more you do it, the more you're going to trust and understand the tweaks that you need to make, or that you want to be able to make, because you're like, oh, okay, I've experienced this now. I've experienced multiple stops. I've experienced multiple winners. I've experienced a market downturn. I've experienced a nice rally. All these things that you've experienced, you can now add into that confidence factor in ultimately in your decision making for stock picking. That'll do it for today's update. I'm going to end on that note. I appreciate everybody's time and effort. Have a fantastic day today. Bye now.